Last year, your truck insurance was around 15 grand. This year, the quote comes back at 21. Same truck, same driver, same business, but the cost just jumped so hard it can wipe out a big part of your margin before you even turn the key. If you want more real trucking breakdowns like this, subscribe to Proud Truck Driver. Because in 2026, a lot of owner-operators are not losing money on the road first. They are losing it before the load even starts. Insurance is hitting harder in 2026 because it is no longer just another overhead line. For a lot of owner-operators, it is becoming one of the biggest reasons a decent-looking year still feels weak in the bank account. The dangerous part is that insurance does not scream at you the way fuel does. Fuel hurts every day, so you feel it. Insurance hurts quietly. It shows up in the renewal, in the monthly payment, in the tighter cash flow, and in the loads you now have to accept just to stay even. That is why this jump matters so much. If your annual premium moves from $15,000 to $21,000, that is not just $6,000 more. That is hundreds of extra miles, extra stress, and extra bad decisions you may end up making just to feed a cost that was not there before. A weak insurance structure can push a trucking business into survival mode without the driver even noticing it right away. So why is it exploding? Because the market is pricing trucking risk more aggressively, and small operators usually get hit first. Higher claims pressure, harder underwriting, more legal exposure, and weaker market tolerance for marginal safety profiles all stack against the owner-operator. Even if you personally run clean, the market does not always price you as an isolated case. It prices the category. That is the brutal part. A lot of truckers think, I did nothing wrong, so why am I paying more? Because insurance is not rewarding effort emotionally. It is pricing exposure commercially. And when premiums jump, the business model changes. A truck that worked at $15,000 a year may not work at $21,000 unless the operator adjusts something else fast. Lane choice, rate discipline, idle time, maintenance reserve, fuel waste, or deadhead strategy. Midway CTA. If you like this kind of business-first trucking content, subscribe, because this is the side of trucking that quietly decides who survives and who doesn't. The real mistake is treating insurance like a fixed number you just have to accept. That mindset kills flexibility. In 2026, truckers need to treat insurance the way they treat fuel, maintenance, and bad brokers, as a variable that forces operating decisions. If your premium jumped, you need to know what that does to your cost per mile, to your weekly minimum, and to the kind of loads you can no longer afford to haul. That is the part many drivers skip. They react emotionally to the quote, but they do not recalculate the business. And when you do not recalculate, you keep booking freight under old assumptions with new costs. That is where the damage compounds. The smartest move is not panic. It is recalibration. What changed per month? What changed per mile? How many more bad loads can your business survive if overhead already rose before fuel, repairs, and dispatch take their cut? Once you answer that honestly, you stop running the truck on last year's math. If your insurance went from 15 grand to 21, this is not just an annoying bill. It is a warning that your whole operating model may need to tighten up. In 2026, a lot of trucking businesses are not failing because drivers suddenly forgot how to work. They are failing because the cost structure changed and nobody rebuilt the math fast enough. If this breakdown helped, subscribe to Proud Truck Driver. And in the comments, tell me this. What hit your trucking business harder this year? Insurance, fuel, or weak rates?